The United States housing market is being destroyed beyond repair by the desperate efforts to stop this horrifying inflation spiral, and the impact of the impending crash will be felt by all of us. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. In recent years, reckless monetary policies have been implemented, fueling a boom in inflation that was unprecedented, driving up housing costs dramatically. The beast they alone unleashed is currently being tamed by central bank policymakers and Washington politicians. Everyone is aware, however, that sharply rising interest rates will have a disastrous impact on the financial markets, particularly the housing market. As mortgage rates rose, more and more prospective home buyers were forced to the margins. Less sales, due to the fewer buyers, put downward pressure on home prices. It appears that federal officials are either completely unaware of this or very aware that what they're doing will be extremely damaging to the American economy as a whole. However, they are still holding out hope that something will happen to free us from this hallway. We are once more on the verge of a housing collapse, as the housing market is in shambles. Do people still have memories of the suffering we all endured in 2008? Well, we are currently witnessing a similar scenario. However, things are about to get a lot worse this time. Even though many industry insiders who, incidentally, have benefited from the expansion of the housing bubble over the past 2 years, keep telling us there's nothing to worry about and that there won't ever be another housing collapse, we should still be concerned. We have been receiving entirely different information from the data. In fact, something in the market that didn't happen since 2008 did so once more last week. For the first time since the financial crisis, the average interest rate on a 30-year fixed-rate mortgage increased above 6%, according to data released on Thursday. According to a Freddie Mac report, the benchmark home loans average mortgage rate has increased to 6.02% last week, up to 0.13 percentage points from the week before and 3.16 percentage points from where it was a year ago. The 30-year fixed-rate mortgage was above 6% for the first time since the week of November 20, 2008, according to the analysts, as perfectly summed up by the financial experts at Zero Hedge. Ultimately, the rise in mortgage rates is one of the most noticeable consequences of the Federal Reserve's initiative to fight inflation by increasing the cost of borrowing for individuals and businesses and stifling demand for all finance purchases. The truth is that higher interest rates primarily hurt low and middle income Americans, while many wealthy people can still afford to buy homes because they can do so without a mortgage. However, aggressive rate increases benefits the rest of us greatly. Each increase raises the monthly cost of a prospective buyer's mortgage payment by hundreds of dollars or more. The average monthly mortgage payment has increased by 38.5% since the beginning of the year, rising to $2,306 from just over $1,700 in January. Mortgage demand is currently declining quickly as a result of mortgages, adding further pressure to already high home prices. According to data provided by the Mortgage Bankers Association, applications have decreased by almost 30% since last year, and with refinancing activity collapsing by over 80%, the number of mortgage refinancing applications has dropped off a cliff. Because higher rates reduce the benefit for most homeowners, refinancing activity has slowed. Applications for home loans have decreased 83% from a year ago, and applications to refinance into a lower payment have decreased by the same amount. Rates are now essentially double where they were. Only 452,000 homeowners nationwide are currently eligible for refinancing. That lowers their rate by at least 0.75 percentage points, according to researchers. Mortgage originations reached $4.4 trillion in September 2021, but it's anticipated that they will drop by half this year. More people are delaying buying a home as a result of higher rates. Many first-time homebuyers are discovering that the door to home ownership is closed for this reason, as real median household incomes have remained largely unchanged. It is becoming more and more obvious that home prices must fall in order to restore balance to the housing markets. With borrowing costs expected to continue rising in the coming months, many vendors are lowering their asking prices in response to the changing market conditions. for everyone currently involved in real estate. The boom that produced record profits for the industry over the past couple of years is now turning into a painful burst. Daryl Fairweather, Redfin's chief economist, claims that the current financial crisis is the worst since the previous crash. Since the housing market crash in 2008, this is the market's most abrupt turn. Since interest rates haven't been this high since 2008 or 2007, it represents a significant shift from the housing market to which we are all accustomed. Simply put, buyers lack the 40% extra cash needed to pay for housing each month. Many home buyers were forced to give up and switch to the rental market, or they opted not to purchase that second home or investment property. Redfin revealed that this is having the biggest effects on bigger cities like San Francisco and Los Angeles. When referring to a home worth $1.5 million, that amounts to an additional $2,000 per month in mortgage payments. Currently, more than 1 in 10 renters nationwide are behind on their rent, forcing an estimated 39 million would-be buyers to continue renting. Additionally, wages are not increasing at the same rate as housing costs. The median weekly earnings for both men and women were $1,045 in the second quarter of 2022. According to the Bureau of Labor Statistics, that's about $4,528 in monthly income before taxes. So households earning that much would spend more than 41% of their income just on rent. Those who spend more than 30% of their income on housing are typically categorized as cost burden, which means that their households may find it difficult to pay for essentials like food and transportation. Additionally, millions of home buyers would have to decide if they could still afford their homes if they were to suddenly lose their jobs if we do experience another recession. A significant housing crash will also result from the rate hikes' continued implementation. People will lose their jobs if the Fed continues in this direction. Companies are expected to suffer severe profit losses as a result of a number of unresolved supply chain problems and inventory backlogs in warehouses, which will only exacerbate the impending crisis. We would still be dealing with a serious nightmare even if central banks stopped raising interest rates and left things alone, but there are no signs that they will. In this last quarter, they will seriously disrupt the financial markets. Officials from the Fed have reaffirmed their intention to raise rates until inflation is under control, and that process can take years, not just a month. What steps can we take to effectively protect ourselves then? If you're selling a house, our advice is to move as quickly as you can while real estate prices are still absurdly high. However, it would be advisable to hold off on making a home purchase until home prices have significantly decreased. And one thing that each of us can do is prepare for the severe recession. Tens of millions of Americans lost their jobs overnight during the financial crisis. All of those people unexpectedly lost the ability to pay their monthly bills after losing their incomes. Additionally, a large number of once middle-class Americans lost their homes. Naturally, we don't want to experience the same fate. So now more than ever, it's important to establish a trustworthy emergency fund that will enable you to keep up with your bill payments, no matter what happens. You won't be as likely to lose your home or be subject to eviction. Additionally, it's crucial to avoid taking on any new debt. When tough times hit, it's better to keep your finances as tight and mean as you can. Focus and financial preparation should be done right away. We need to keep in mind that this winter could bring with it a number of crises that could explode simultaneously. Those who are wise will plan ahead, but the unwise won't do anything because they still think our leaders have everything under control. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.